It's April 2026 and the spring market is officially here in New Brunswick, but it is not the spring market that we are used to over the past 5 years. It's slightly different, and in this video we're going to be going over exactly what those differences are compared to the last 5 years, because things are shifting. But first we're going to be going over what's happening all around Canada, take a quick look, and then we're going to zoom in to New Brunswick specifically. How's it going, everybody? My name is Brandon Vincent with eXp Realty. I'm a real estate agent here in St. John, New Brunswick. I've been actively selling real estate for over 7 years with over 130 deals under my belt. My goal on this channel is to bring you relevant real estate information in an entertaining way. If you like the sound of that, do me a favor, hit the like, subscribe button, follow along for the journey. If you like what you're seeing here or you have any questions, leave a comment down below. I'd love to hear from you. But without further ado, let's dive in to this April market update for New Brunswick. So starting off, looking at the Canadian economy as a whole, Canada adds 14,000 jobs in the month of March, which is the first month adding jobs all year. So up to this point, we've been losing jobs month after month, January, February. Now we're looking at March and we've added 14,000 jobs, which it's not a lot, honestly. And it's not a great sign of a rebound for the market, but it's good to see that we've at least stopped the bleeding from the job losses over January and February. So Statistics Canada says that the labor market added 14,000 jobs in March, keeping the unemployment rate at 6.7%. The jobs gained were mostly in line with economists' expectations and mark a modest rebound from the sharp losses across January and February. So the slight job growth that we've seen was led by a category the agency calls other services, which includes repair and maintenance work in the economy, as well as the professional, scientific, and technical services and natural resources industries. Now, the tariff-sensitive industry eked out a few thousand job gains in March, while the finance, insurance, and real estate and leasing sector led last month's losses. So as I mentioned on our last market update for New Brunswick, keeping a sharp eye on the Canadian economy in general is going to be very, very important as we move through this year, especially as we're dealing with a lot of the geopolitical uncertainty, energy uncertainty with everything going on in the Strait of Hormuz, which has increased the oil prices, which I believe that we are just starting to see some of the effects of that. We've already been seeing it at the pumps, but we are going to be seeing the downstream effects of the increasing in oil prices, which are going to come out into a massive inflation, in my opinion, which I want to go into how that's going to affect things like home building and the home prices as we move through 2026. Now, here's an interesting article from CBC, which was just published here April 7th. And the headline is, House Prices Dropping in Canada's Most Expensive Cities, but Still Out of Reach for Many. Experts say it's still not a good market for first-time home buyers, and this is really sad. And they say it may never be. What a statement. And I want to go into what they're talking about here, because I've been doing a lot of research on the housing starts and then just doing some basic math of if inflation is going to be increasing, that's going to slow down the amount of homes that are being built, because if builders aren't able to turn a profit, then the amount of homes that are being built are going to hit a wall and not meet the doubling requirement that CMHC has been stating since about 2023 that we need to hit by 2030. Starting the year off in 2026, a lot of banks made predictions on where the housing market was going to net out here in 2026. And now a lot of those banks are actually pivoting and making adjustments on their predictions, which I think is absolutely critical, especially given the amount of things that have changed since January to today. So TD Economics said in a report last week that it expects home prices to slide 0.3% across Canada this year now, when before their prediction was that we were going to see an increase in home prices. After a weak performance in the market over the last 2 quarters, with Ontario and BC facing the biggest drops. Also looking at interest rates, which will determine the mortgage payments, are also low by historical standards, though not as low as they were before and during the COVID pandemic. I don't know if we will see the rates get back to that low. That was a stimulating effect that the Bank of Canada was doing to reboost the economy after having the economic crisis that we had during the pandemic. And here's another stat that's not overly exciting either. Nobody wants to build. So Statistics Canada numbers show median real hourly wages adjusted for inflation grow 20% from 1981 to 2024, while inflation adjusted home prices grew 163.5%. That is part of the problem as to why going back to it may never be a good market for first-time home buyers, because that discrepancy is getting so large. And a big part of that is the fact that we have supply issues happening across the country. We've had that going on for the last 6-7 years. CMHC has made reports stating that they expect us to, or they require us to double the output of houses that are being built by 2030. That we need to do that year after year after year in order for us just to maintain proper supply of housing by 2030, which we are now seeing with the expectations of inflation hitting us harder throughout this year. The expectation is that the amount of homes that are being built is actually going to drop. So the realistic expectation of being able to double the output by 2030 is getting further and further from reality, meaning that they don't expect the supply issue to balance itself out. So I started running this scenario through Gemini, asking if the Canadian housing starts, which is how many homes are currently being built. A start is when a foundation is poured. That's considered a housing start. So that's how you're tracking how many houses are currently being built in order to see what the future output is going to end up being. So I asked, are the Canadian housing starts keeping up to the demand of the growth of the country? Because I've heard that we need to double the housing starts to keep up to the housing demand. It said, you are absolutely on the money. The idea that Canada needs to double the housing starts to fix the affordability crisis isn't just a rumor. It's a target set by the Canadian Mortgage and Housing Corporation, CMHC, though we are currently trending in the opposite direction. So here's a breakdown of those numbers as it stands as of early 2026. So the 5.8 million math. To restore housing affordability to 2004 levels, by 2030, CMHC has estimated that we need to build roughly 5.8 million homes. The baseline of what we are currently doing, if we just stay business as usual, Canada has projected to build about 2.3 million homes by 2030, meaning that we are below half the required amount if we just continue to do business as normal. So the gap is roughly 3.5 million units, having a shortfall of that many homes, which is absolutely staggering. So to bridge that gap, Canada would need to build roughly 550 to 600,000 homes per year, since we typically average around 200,000, 250,000 homes per year. So this is running the simulation of carrying on with business as normal by 2030 that we're going to run into, where affordability becomes a legacy concept. So currently the goal is to get the housing costs back to roughly 30% of the household's gross income. And the business as usual scenario, if we don't double the starts, then experts project that by early 2030s, the affordability ratio in the major hubs could soar to 50 to 80% of income. And then another scenario that we run into is the suppressed household formation. And this is a clinical term for a social crisis. If there aren't enough doors, people simply don't move. Then we have the basement generation. We will see a massive spike in adults in the 30s and 40s living with their parents or in overcrowded multi-generational housing. And then you have economic stagnation when people can't move to where the jobs are because they can't find a place to live. Canada's overall economic productivity drops. We are already seeing brain drain where young professionals leave for more affordable jurisdictions in the US or the prairies. And then it goes into saying that the single family becomes a luxury product. So if we don't double starts, the single detached home with a basic yard essentially becomes a luxury good reserved for the top 5 to 10% of earners. That is not an ideal situation for anybody in Canada, which is crazy. So it's something to keep our eye on. This is something that I wanted to share and just at least put it out there so that people can kind of see what some of the experts are talking about. This is all really stemming from CMHC's philosophy of needing to double the housing starts. Now, what does that mean for us here in New Brunswick? Well, let's take a look here. So in these scenarios, as Ontario and BC become more impossible, the migration to the Maritimes will continue. So I can see that. So if we remain one of these spots that has the lowest bar of entry for real estate, it's still going to make us very enticing in these very archaic scenarios that are actually almost hard to imagine. As Ontario and BC become more impossible, the migration to New Brunswick will continue and the Maritimes will continue. If our local starts don't ramp up, St. John will experience the same price decoupling we saw in Ontario 5 years ago, where local wages no longer have any relationship to the home prices, which we've already kind of started to see. If this scenario does arise, that things could get very difficult for first-time home buyers, meaning if there's an opportunity for you to get in the market in the near future, if you are starting to think about buying a home, getting your foot in the door, then doing so before things ever get to that point that I was just talking about could be a good call. So finding ways to get your things organized so that if you are looking at a home in the next 2 to 3 years, if you're looking at getting in the market, if you're looking at getting your foot in the door, if you're looking at establishing yourself and your family in a home, then this could be a great time, especially during some of this uncertainty, because nobody knows what's going to happen. But one thing that does seem to be a almost for sure thing is the fact that supply is going to remain an issue in the coming years, which I believe is going to keep upward pressure on the home prices. Now let's do a quick look at the New Brunswick employment trends. So the unemployment rate in New Brunswick was 6.9% as of March 2026, which is up 0.1% from the previous month. The unemployment rate stood at 6.3, below the peak from June 2020, and is below the long run average. So there were unchanged full-time jobs in March 2026 compared to a month earlier, combined with a gain of 1,200 part-time positions. This led to an increase of 1,200 total jobs in March. So that's really good to see. Full-time employment has recovered since reaching the bottom in September 2025 and now stands at a record high. That's great news. So the full-time monthly job growth, you can see we just have a little slither here of a job growth, just barely noticeable on the chart. Now, if we're looking at year over year full-time positions, we've seen a lot come in the manufacturing, and we also seen a decent amount in healthcare and education, as well as business and building. But we've seen a loss on the agriculture, the natural resources, the utilities. We've seen a loss on transportation and warehouse, on financial sector, and on the professional and scientific, as well as accommodation and food, other services, and public administration. So now we're going to quickly go over the major regions in New Brunswick to wrap this video up so that you can see what is going on in the 3 major regions, being St. John, Moncton, and Fredericton. Starting off in Fredericton. So Fredericton for the month of March had seen 153 sales with $55 million in gross volume. Now, we've also seen 329 new listings, with the active listings in Fredericton being at 591. The sales to new listing ratio, we're seeing it drop to 46.5%, while the months of inventory is below 4, meaning that they're in a seller's market at 3.9, and the average home price being $362,934. Now, the sales to list price ratio is just below 100%. So then you're seeing less properties selling over asking on average, but not by a significant margin at all. And the days on market are still pretty quick at 22 days for Fredericton. Now, starting off in Moncton, for the month of March, we have the active sales at 222. We've seen 81,499,000 in the dollar volume sold. We have 458 new listings, with the active listings in Moncton being at 1,092, which is the highest of all three regions. Moncton normally has more sales activity. I actually have noticed that they normally have double the sales activity of St. John and double the volume, double the listings, normally double just about everything. And the sales to new listing ratio, 48.5%. While the months of inventory, they are pretty well smack dab in a balanced market for the Moncton area. While their average home price is $367,000 and their sale to list price ratio being at 97%. And the median days on market, 41. So almost double what it was in Fredericton. But let's take a look here in St. John. So St. John's seen about 122 sales activity for the month of March. We've seen $44 million for the gross volume. Our new listings are at 239, while the active listings are at about 504. The sales to new listing ratio being at 50%. So that's about 50% of the inventory is selling of what's coming on the market. We have about 4.1 months of inventory. So we went from about a 4.7 to 4.1 for the month of March. So that's pushing us back towards the seller's side. So we are right now just on the edge of that seller's and buyer's market, with the average price being at $366,000 and the sale to list price ratio being 103%. So then that means that on average, properties are selling about 3% over the asking price, while our days on market are about 21 median days on market. I hope that helps paint a picture of what is going on. The real estate is still holding its value strong. That's one thing to take note of here in New Brunswick, is despite some of the shifting market that we've seen, it's not really having a direct effect on the housing prices in any majorly significant way. It is slightly, but what I'm seeing is that buyers are becoming much, much more picky. And that is across the board, across the entire province. And also what I'm seeing is that it is significantly that much more important when you're listing a property that you have a rock solid strategy when it comes to your pricing plan, your marketing strategy, what you're doing for videos, for your photos, for drone, that whole marketing package. That initial wave of listing your property is now more important than ever, especially as buyers are getting much more selective. So they're not buying everything up anymore. They are definitely looking for the right priced homes. Buyers also are slightly confused right now because the market is shifting. So it's shifting from what we're used to over the last 5 years. And some buyers are hearing that, but what they're not seeing is the prices come down. So it's almost like buyers are probably expecting the prices to come down, but that is not always the case in a shifting market. What it just means is the supply and demand is shifting as well. So there's a lot more uncertainty currently in what's going on in our market because of a lot of things geopolitically. So people are keeping their eye on that. Also, too, I know that we had some expectations on the Bank of Canada dropping their interest rate. That was the original prediction at the start of the year. That is not looking like it is going to happen now coming into the rest of the year. I think the Bank of Canada right now is in between a rock and a hard place, where if they dropped rates, then they risk really throwing off the economy, because then inflation is just going to become absolutely rampant with the price of oil rising. You never want to drop rates while you have high oil prices, from my understanding. And then also, if they end up increasing the rates, then that's just going to absolutely grind the economy to a halt. So I think that they are just going to pretty well hold and see what happens. That's my prediction here right now. But with that being said, I hope this has been of value to you. The reason I make these videos is to spike some curious thought, actually talk about the numbers of what is currently going on, what I'm seeing, what's going on in my head, what I'm thinking about, looking forward. I'm always trying to paint a picture and shine a light of the future so that I can figure out how to have higher level conversations with my buyers, sellers, and investors. Thank you guys so much. Hope you have a great day.